Welcome to our last module on inventory. In this module, we'll cover shrinkage, the income statement, and the periodic inventory system. Let's start with shrinkage. Shrinkage is an economic event that occurs because inventory disappears due to theft, breakage, or other unknown reasons. Accounting records need to be adjusted to reflect the loss of the inventory from shrinkage. How do we do this? We first start by examining our inventory account. Here we have our inventory account that shows our purchase of inventory, the return and sale of inventory, leaving us with 100 units for a total cost of $300 in our accounting records. At the end of each accounting period, we need to count our inventory. When we count our inventory, we determine that the actual inventory on hand doesn't match our accounting records. Instead of having 100 units, we have 95 units on hand. So we need to make our accounting records match what we actually have on hand. So if we have 95 units on hand, each unit is approximately $3 per unit. So that means we need a balance of $285 in our inventory account. How do we get from 300 to 285? We need a credit of $15 in our inventory account. That means we need to make an adjusting entry. Our adjusting entry includes the credit to inventory for $15 to get us to the desired ending balance, and it also includes a debit to either a loss account or cost of goods sold. Both of these accounts reduce net income. It should be logical that if inventory disappears, that's a cost of doing business that should increase our expenses and reduce net income. The next thing we want to look at is our income statement. If you recall from the second module, we had sales revenue of $6,860. We also had cost of goods sold of $2,099, but we just added an additional $15 to cost of goods sold from our shrinkage, bringing our cost of goods sold up to $2,114. That gives us, with sales revenue minus cost of goods sold, gross profit of $4,746. Gross profit is just the difference between sales revenue and cost of goods sold, but it's an important number that financial statement users use to analyze the profitability of the business. Finally, we want to look at our accounting systems. We'll start by reviewing perpetual. Under the perpetual system, we update the inventory account when inventory is purchased and sold. It provides more detailed information, and it's preferred but may not be cost effective. Now we want to look at periodic. Periodic only updates the inventory account at the end of each accounting period. It provides less information, but it's useful when keeping detailed records on specific units sold is not cost effective. How do we do the periodic system? In the periodic system, we purchase inventory by debiting purchases and credit accounts payable. The difference here when compared to the perpetual system is that inventory account is not debited, the purchases account is. When we sell inventory, we debit accounts receivable and credit sales revenue. We do not make the entry to record cost of goods sold and lower inventory like we do in the perpetual system. The only entry required when we sell inventory is to record the sale and accounts receivable. Finally, at the end of the period, we need to make some calculations. First, let's define beginning inventory. Beginning inventory is equal to the ending inventory from the last period. Ending inventory is equal to the inventory counted at the end of the period, and purchases will be equal to the balance in the purchases account, which is also equal to the total purchases for the period. If we add beginning inventory and purchases together, we get the goods we have available for sale. What we started with plus what we bought gives us our goods available. If we subtract our ending inventory from goods available, that gives us cost of goods sold. What we have available minus what we have left over is equal to what we sold. Our adjusting entry at the end of the period is to debit inventory for ending inventory, debit cost of goods sold for the cost of goods sold, credit inventory for beginning inventory, and credit purchases for purchases. This journal entry will update inventory so that it is equal to the inventory that we have on hand, record the cost of goods sold for what we sold plus shrinkage, and close out our purchases account. It's important to do this adjusting entry before preparing financial statements. Finally, in review, we covered shrinkage, which is inventory that is lost due to theft or breakage. Shrinkage requires an adjusting entry to lower the inventory account to match the physical inventory count. The periodic inventory system is primarily used when the perpetual method is not cost effective. When we purchase inventory, we debit purchases and credit accounts payable. When we sell inventory, we debit accounts receivable and credit sales revenue. And we make an adjusting entry before preparing financial statements to debit inventory, debit cost of goods sold, credit inventory, and credit purchases. This wraps up our last inventory module. Now is a good time to practice some of your problems.